If you have an incorporated business and you're investing inside your corporation, there is this rule that can increase your business taxes even if your business is doing the same. And most people don't even realize until the damage is done and they end up having to pay the taxes. Now, let's understand why incorporated business owners lose their small business tax rate when their passive income, which is their investment income, crosses $50,000. Many people have this belief that if I am incorporated, I will be saving taxes. And then if I'm investing inside my corporation, I'm not pulling money out, I'm not paying personal taxes. That is one of the very best moves, and that is the smart moves. That is the belief that people have. And the biggest, most thing that people say is that, oh yes, my investments are doing this, and my accountant is going to handle my taxation. Guys, this is not how it should be done. The reality is that your investments inside your corporation can directly affect the tax rate that your actual business income has to pay. Now, what is your small business deduction? So, your small business deduction simply means in Canada, if your corporation is earning $500,000 of net income, depending on your province to province, you would end up paying 9 to 12% of your taxes in the corporation. But the moment your investment income, not your operational income, but the moment your income from your investments increases $50,000, this tax rate, this small business deduction reduces, that end up increasing your corporation's taxes. Guys, this is directly affecting it. Now, how it works and how it will be affecting you, let's read a little bit. Guys, it simply says that the moment your investment income in a Canadian corporation increases over $50,000 and it's between $150,000, it will affect your small business deduction. How it will affect? This is the formula that your business limit divide by $500,000 multiplied by 5 into, and then you have your investment income minus $50,000. That is the requirement of the passive income, of the minimum requirement where it will be affecting your small business. How this formula works, let's look at this example. For example, ABC company is having December 31st, 2020 as their taxation year end, and they had $75,000 of investment income. All right. Now, looking at the same formula, 500,000, that is their business limit, and then divide by 500,000 into 5, multiply, then you have your $75,000 of your investment income minus $50,000. It comes down to $125,000. Now that means you minus $500,000 minus 125,000, you're left with $375,000. It simply means if your business is making $500,000, if you did not had any passive income, you would have paid, depending on your province to province, 9 to 12% of the corporation's taxes. But now, because you had $75,000, it will reduce your small business deduction by 125, which means on the $375,000, you would pay the same rate, that will be 9 to 12%. But whatever the difference is, $125,000, you would pay the higher rate depending on your province. And on this another $75,000, your passive income tax rate will apply. That will be 51%. There is a portion of refundable tax included in it as well. We will be covering those things in our next videos. But this is how your small business deduction is affected by the passive income if you have it in the corporation. Now, this is the problem that is there. How it can even make it worse, good market years, it makes us feel that one investment, it's a very good year, my investments grew up very beautifully, it makes it look good on the piece of paper, or it make it look good on in numbers. But then you also need to consider that it has affected your small business deduction as well. And CRA is there to just take money from you, so they're not going to send you any warning letters or anything like that. Well, these are the CRA rules. You cannot play with it. All you can do is plan accordingly. but then they're not going to send you any warning letter because that is you earned that income, that is the passive income, and they want their piece on it. And now, guys, biggest thing is accountants report it, but they don't always plan around it. Okay, accountants, they are there to help you out, right? But if you're not sitting with them, if you're not asking them, hey, how much is the tax bill that I'm paying? What is the percentage? How much is the income that we showed? And if you're not sitting and planning with it, not accountants are not going to do themselves. Their job is to actually just report whatever you have given them. So accountants are always working backwards that hey, you gave them these statements, this is what you have already done. So damage is already done. All they have to do is accountants have to put those numbers into the books and report it. They cannot even plan around it because the damage is already done, right? So accountants has to work backwards on whatever you have already given to them. So sit down in case you need to plan. Now, the real cost. Why exactly do you need to plan? Who cares? That's fine. If I want to pay taxes, there are those taxes, I pay it. Who cares, right? But no, let's look at what your real cost is. Well, if you're paying too much into taxes, of course you have less money to reinvest. So how will you be creating your wealth if you don't have enough money to reinvest? And you will be having less money to pay your own self because CRA is taking too much money. So you're giving whatever the tax bill portion is, right? So you're giving those tax portions to them. And of course, because you gave it away, you will be having less to spend for your own self. Now, your retirement, because you had less for your own self, less to reinvest, of course, the biggest vacation of your life. That is the retirement. You may be thinking, oh, I'm going to build $1 million portfolio. I'm going to go to this vacation. I'm going to buy a nice yacht. I'm going to go on a cruise vacations, whatever you would have decided. Well, everything becomes less efficient because you gave away too much money in the form of taxes. You couldn't save enough for your own self and for your family. So this is what your real cost is. Now, but what if you don't invest? Well, that's a wrong thing because right thing to do is investing because if you're not investing, then inflation is eating up your money as well. That could be depending on 3-4%, whatever the rates are, right? But then if you don't do anything, then inflation is eating up. And if you do something and then CRA is taking money. So how would it actually make sense or what can you do about it? Well, how can you actually plan is now you have to coordinate your investments not only with the rate of return. Because think about it. What if there is one investment that is giving you 50% rate of return, but then taking away 50% in taxes? But what if then there is another investment that is giving you lesser rate of return, but it's helping you plan for your taxes as well? So you know it's not only that you always have to look for the returns, but you always have to look for what is the tax strategy for my investments as well. You simply need to know where to invest, not only what to invest in. You like the property, you said, hey, I want to buy this rental property. You went ahead, you bought it, and then you got to know there is 51% passive income tax. And then you got to know when you sell it, there is another capital gain tax. And if you purchased it in the corporation, you got to know that when that money comes out of the corporation, the taxable portion is again, you will be paying personal taxes on it. So it's like tax, tax, tax everywhere. And not to mention the money that you would have purchased the property from, you would have already paid taxes on that as well, right? So it's not only that you find one investment, somebody told you, realtor told you, hey, this property is gonna give you double the return in next coming years, right? And then you went ahead and invested in, but you need to know like where to invest and how to actually strategize those things. It's never only gonna be the biggest mistake, guys. It's never gonna be about today. Because I can tell you, hey, invest into RRSP, you will be saving your taxes today. I'm not saying that's a wrong advice, but you need to plan years ahead. Many people, majority of the people, they end up saving taxes today, but they end up losing their wealth as they keep going ahead. Because that is how the system is designed. System is designed to make sure we live paycheck to paycheck because not everyone deserves to be wealthy. But if you plan around it, there are ways because there are people, those who are planning for it as well. So if you want to plan, we have to make sure we sit down. But in case if you don't worry about it, then that's fine. I mean, keep paying taxes and that's all what majority of the people are living as their retirement, right? Now, you have to align the corporate investing with the retirement goals. If you're a long-term investor, if you want to build wealth, if you want to build like generational wealth, it's not only what you're going to do today, it's always going to be about what your kids are going to get tomorrow. It's always going to be about how your retirement looks like tomorrow, right? What you want to do with your spouses, with your family, wherever you want to go on vacation. The more you have, the more you can spend. It's as simple as that, right? So I want you to understand that incorporation is just a tax tool, but without strategy, it can backfire you. Because incorporation, you would always pay more taxes as comparatively to the personal for the investment side of things. But guys, it definitely gives you more flexibility, more control. But if you're not planning for it, it definitely will be backfiring you down the road. And selling things will never be the solution. So make sure we take this wealth creation seriously. It's your hard-earned money. Take it seriously. Don't end up giving too much away. I will be covering more details in my coming videos as well on how to plan for it in the numbers as well, some examples as well. I will be covering those in my next video. So feel free to subscribe, feel free to like, comment, whatever it is. And in the comment section, feel free to give your feedback as well so that I know what to cover next. But guys, this is your hard-earned money. Let's take it seriously. Thank you for watching.